Okay, it's noon, so we'll get started. Hello, everyone, and thank you for joining us today. My name is Kelsey Lefebvre, and welcome to the 2026 Green Industry Outlook webinar. Before we get started, I'd like to offer a few technology tips to keep in mind while you're viewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be a time for questions and answers at the end of the presentation. Questions can be submitted at any point during the presentation using the question mark button on the right side of your screen. This will expand a text box for you to then type in your question. Lastly, a recording of today's webinar and presentation materials will be available at farmcrediteast.com as well as on our YouTube channel. And now a quick disclaimer, this information is presented in good faith and is not intended for investment, tax, or legal advice. I will now hand it over to my colleague Chris Lawton to introduce our speaker today.
Hello everyone and welcome on this snowy Northeast day. Our speaker today is Dr. Charles Hall, or Charlie. He's the professor and Ellison Chair in International Floriculture at Texas A&M University, where he's been for a number of years. He's also the chief economist of American Hort, which is the, excuse me, which is the major horticulture trade association in the United States. Other than that, he really needs no introduction. He's a renowned speaker worldwide as well as nationally, and known throughout the horticultural world as the go-to guy for nursery and greenhouse economics. So with that, I will turn it over to Charlie and let him take it away. You're muted, Charlie.
Sorry about that. Can you hear me now? Okay, awesome. Thanks very much, Chris, for that introduction. And I'll go back to my slides here. Make sure everyone should see the first slide, 2026
Yep.
Green Industry Outlook. So we're good to go there. And I don't see you, but you evidently see me. And so we'll kick things off. I appreciate the invitation to do this. I was just talking to Chris a few minutes ago about how many years we've been doing this, and it's been at least 10. And you know, it's if you trace back through time, and some of the things that I've said over the last decade have actually come into fruition. So if as a amateur futurist prognosticator, I guess the track record is pretty good. There's been a few surprises. A few things have popped up along the way that nobody was expecting, including in 2025 when we hit the ground running with some tweets on tariffs, and of course that came into fruition. And all through the the first quarter of last year, we saw a lot of people scrambling to get product in, particularly inputs from different parts of the world before the tariffs hit. So you'll see the impact of that when I get to a chart a little later on talking about the GDP performance from quarter 1 last year. But I thought what I'd do is in normal fashion, this is kind of what I typically do in this particular webinar. I talk about the green industry and how it performed in the previous year. And then I set the stage for 2026 by doing a deep dive on the overall growth of the economy, what direction are we headed, up or down, and then how's the supply chain moving in terms of risk and uncertainty. A little bit on the inflationary outlook for our inputs that we use in the green industry to grow, install, and retail high quality plant materials. And then, of course, the labor outlook. And there's not a whole lot that we can do about that, but forecast for what labor is going to do in terms of the availability of labor and also the cost of labor. And then focus on the housing market. And I do this every year because we're strongly correlated with housing. And so as the housing market goes, the green industry goes. So that's pretty critical in terms of our overall performance. We do a little deep dive on the consumer again, and then end with, are we looking at economic growth and contraction? What do we do about it? That's the key thing. What are the key success factors for 2026? So with that, I'm going to go through and walk through the green industry supply chain. You can see it depicted here on this slide, all the way from the allied trade, producing all the inputs that we use, growers there in the yellow rectangular box where I got my cursor. And then there's various channels that product moves through to get to the end consumer, whether it be a homeowner or whether it be an institutional buyer. Then there's various ways in which folks get our high quality flowers, shrubs, and trees. Now, in a nutshell, if I were to characterize 2025, it was very mixed. I mean, there were some folks out there that hit a home run during 2025. Top line sales were up, bottom line net profits were up, units were up. I mean, it was the trifecta, but not everybody. In fact, there were some in which it was exactly opposite. The top line sales were down, net profit was down, or EBITDA was down, and then units were down. So it was truly, in most sectors, it was truly a bell-shaped curve for each one of those three metrics, in terms of either being up year over year or down year over year. So it's very mixed, and it was scattered all throughout the country. There wasn't a particular region that was so far above and beyond the other regions, but definitely weather had an impact in terms of how things played out. And if you look at grower performance, and of course I'm collecting income statement, balance sheet data from growers right now as part of my Your Market Metrics benchmarking project. And there's 44 out of the 80, 88 or 89, roughly half the growers have submitted data so far for 2025. And so for over the next couple of weeks, I'll be getting the rest of that data in. So I'll have a little better picture, but right now the handwriting's on the wall. That top line sales for growers as a sector were up about 4% roughly in terms of some of the preliminary numbers. Again, everything that I'm talking about is preliminary. But when I gave my outlook on the stage at Cultivate last year, there were about 3/4 of the growers whose sales were up year over year, and about 80% though were up compared to 2019. And that's I always try to make the point. Now, when you start making these year over year comparisons, that just because you had a decrease year over year in terms of the percentage increase or decrease of your top line sales or net profit doesn't mean if it was down, that the sky is falling. Doesn't mean that at all, because you could have very well had the historic high level of sales for your firm in 2024. And if you didn't meet that historic high in 2025, then the year over year performance is going to be down. So you don't freak out in terms of these year over year performance numbers. So I always like to tell folks to take a look at the last 3 year average. What's the trending over the last 3 years, and compare back to that. And then, of course, since we had such an expansion of demand during the pandemic, it's always good to compare back to 2019, which is the latest pre-pandemic year in which there wasn't an influence there by COVID at all. So again, most folks were doing good in terms of top line sales. And if you look at net profits, the same thing. Most were above 2019 in terms of their net profits. But in terms of units, 50-50. I mean, literally split down the middle, flip a coin, and some growers were up in units and some growers were down in units. And we see um, a number of interesting things in terms of inventory. There were some product categories that were short. There were some product categories that were long. And a lot of it depend on which inventories were being built during the pandemic, built up, because there's definitely folks that use PPP dollars to keep labor employed, of course. but some of those dollars were also spent paying down long-term debt. Some of it was put into CapEx, and some of it was put into building tradable assets, i.e., inventory. And usually, when you have those kinds of injections of dollars into the green industry, you see a bullwhip effect come about. And indeed, we're seeing some product categories, some sizes, the 2-inch trees, for example, certain species are getting a little bit of pressure from the supply standpoint of this bullwhip effect. You know, you have when you crack a bullwhip, then the whip goes up and then it comes out slowly over time. And it's got the pig and the python is the better analogy, probably. Is you got this buildup in inventory and it's got to work its way through the supply chain, and that's what we're finding right now. But no surprise, we knew that was coming. I talked about it over the last couple of years in this webinar, and said that this we're going to see this bullwhip effect. And you know, the just like last year when I was it was it was when I was giving this webinar, I was talking about the increase in imports that were happening because of of course, the tweets that time regarding tariffs. And sure enough, it played out that way. Now, let me move up the supply chain. Let me go to the landscape first. So the landscapers during the pandemic were one of the few service businesses that had actually exploded. I mean, there was so much demand that many landscapers had months of backlog, and they've worked through that backlog and have had to become salespersons again to sell landscape projects because that expanded demand was satisfied in 21, 2022. And then when a household buys a landscape one year, they don't come right back the next year and buy another landscape. Then you see all right, there's a filtering out and there's a gradual decrease, and that's what we've seen. So the landscape sector has right-sized and normalized, if you will. And it's also a sector we've seen a tremendous amount of merger and acquisition activity, mostly acquisition activity. And we saw it right in the aftermath of the great pandemic, because anytime you have an economic shock, either gains like in the 2017 Tax Cut and Jobs Act, or you have decreases like from the pandemic or the Great Recession, anytime you have those economic shocks, you have merger and acquisition activity in the landscape sector. You can just count on it. And these landscapers are trying to build economies of scale to be able to compete against the Brightviews of the world it's a $2 billion, well, they may be more now, but a $2 billion landscape service firm. I didn't think I'd ever use those words together in the same sentence in my lifetime, but there it is. And so you're seeing a lot of regional players purchase smaller operations to garner those economies of scale so they can compete in a consolidating market. On the retail side, the IGCs, again, same mixed performance. And a lot of that was dependent on weather and the statewide economies, the difference between states in terms of economic performance. And I've got a great map that I'll show you here in a second, but that was directly correlated to independent garden center sales. And even lawn and garden activity at the box stores. There were some states that were not created equal in terms of that box store performance either. Although as a whole, box store sales increased year over year. Well, you look at it quarter by quarter, and there were some box stores that outperformed others. And I'm not saying that it was good for all of them. There were some, and I won't mention colors like orange or blue or what have you. I'll just say that even across the box store sector, the top line sales were mixed, and EBITDA which they report in terms of their earnings calls and everything, even that was mixed within box stores. So a lot of it depended on how well their merchandising activities were going, and that goes right along with the green industry as well. Those growers selling into box stores, those who performed better than others were those controlling their own destiny with their own merchandising teams. So there's not just growing good quality products, but you got to, in those cases, you got to merchandise good quality products. So again, for the green industry in 2025 is very mixed. So here we go. We're going into 2026. We thought we had a little better feel for how the tariff situation is going to be right up until this past week, right? And and then we get another monkey wrench thrown into the works. And so now we've got some more risk and uncertainty that's being built into the supply chain. And you saw some movement in the markets, although I'll just say the stock market is not the real economy, right? The stock market responds to expectations. And of course, when anytime you have changes in fiscal policy measures or monetary policy measures, the market's going to respond. And they had already priced in a lot of the risk associated with tariffs. And so you saw some movement, but not as much movement as you would expect. And so now we've gotten a global 15% increase in tariffs. And this, when you take a look at this GDP chart right here, this right smack dab in the middle where you got minus 0.6%, that's where the GDP was negative in Q1 last year. And remember, when the tweets started coming about tariffs being put in place, folks got busy as all get out trying to get inputs into the country as fast as they could, but to beat the tariff deadline and to stockpile a lot of the inputs. And so when you look at GDP and the makeup of GDP, you got consumer expenditures, you got government expenditures, you got consumer expenditures. How can I draw a blank on this? The fourth component is net exports, right? And so when you've got and business investment, that's right. So you got government expenditures, consumers, can't forget about the businesses. That's what you guys are. And interestingly, when you guys, every dollar that you spend as a business and you invest in people and equipment, it's a 4-to-1 return economically in terms of the contribution to GDP. When we spend money as consumer, when you and I buy flowers, shrubs, and trees, and all the other things we buy to eat and wear clothes and so forth, there's a 2-to-1 return. So that's why you guys are so critical to the national economy. Now, let me focus on that fourth leg for a second, the net exports, because when we export to someone else, we get paid for that. That's an injection into GDP. When we import from somebody else, we pay somebody else for that product. And so it's a net drain on GDP, right? So that's the buildup in imports that we're seeing right there when GDP was negative. And then when we had bought everything we could, then exports carried the day, and that's why we had to rebound in the second and third quarter. And of course, we saw the latest release on GDP in the fourth quarter was down to 1.4%. Why? Because you can't sustain this kind of level of economic performance indefinitely. Even in the wake of the Bipartisan Infrastructure Act, the CHIPS Act, and other other COVID relief measures that were put into place at the end of the Trump administration and the start of the Biden administration, those you can see that economic performance, that stimulus policy, fiscal policies, it worked, right? But it created a lot of inflation. Well, we economists said that was going to happen. So here you got the big jump in second and third quarter. We always see an increase in second quarter, and it was pretty decent. But now you see that we're paying the piper, right? You can't sustain this forever. And so you got GDP estimated at 1.4, and you can see the forecast in the light blue going forward. So we're going to be lower than our historical average in around 2%, right? We've been all through the years after the Great Recession. We were 2.25. It was kind of boring to be an economist, and we weren't going up or down. And we economists were saying if only something would happen to create some excitement and that we could talk about. Well, so there then entered the great pandemic. So the great shutdown, we call it. So, careful what you ask for. Now, here's when you see the Q1, 2025 Q1, the light purple there is all those imports putting a drag on GDP. So that's why that was negative. So I just call your attention to that. There's the weekly economic index that the Dallas Fed office puts together. It's short-term metrics of economic performance. So you got GDP as a little longer-term outlook, and this is week by week. You got 10 different measures that are brought into this weekly economic index, and you can see the theme there is we're moving sideways, right? We had a huge increase during the pandemic, and then we've normalized or back to where we were pre-pandemic in terms of this moving sideways. So it's not nothing to write home to mama about. It's not anything to cry in your milk about, but we're moving sideways. That's pretty much a theme of the entire industry right now. We're kind of moving sideways. We're not gaining a lot of ground. We're not losing a lot of ground. We're just moving sideways. And I'll show you that in terms of the statewide performance. These are December numbers. This recently came out, and this is the state GDP, if you will. Some of the coincident indicators are not leading indicators. It's what's going on right now. And as of December, you see the states that are behind the eight ball are the light colored or the orange, light tan. Those are states where the economic performance was less than those that are darker blue or darker green. You can see that Texas, where I'm at right now, between 0.1% and 0.5% gain in GDP growth, and that 3-month moving average there in terms of economic performance. Now, why am I showing you this? It's because I just said that a lot of the variation, the mixed results that we saw in the green industry were not just only tied to weather, but differences in economic performance in the states in which those businesses are located, or the states in which those businesses ship to. Right? We do a trade flows analysis every 5 years, we being some research colleagues and myself, and we look at product flows all around the country. And sure enough, you can see if you're in Ohio and you're shipping into the Midwest, you can see that that's pretty good economic situation. I mean, you got the light green states that aren't knocking it out of the ballpark, but they're not negative. Then some of the darker green are growing a little bit faster. And of course, Missouri there, I don't know what they must be on something that's drinking Red Bull or something, because they're growing at a faster rate than anybody else in the country as of December. And we'll see how the first quarter numbers turn out. All right, so inflation, if you look at the supply chain, this is the global supply chain pressure index. And in spite of the fact that the Northeast is going to get a foot of snow and so forth, the supply chain actually has been pretty good. It's only been recently, and this was as of January 31st. So we see a little bit of spike there in terms of the overall risk within the supply chain. But again, it's been moving sideways as well. We learned a whole heck of a lot of lessons during the pandemic in terms of the supply chain and that where we were susceptible. And there's been a lot of stop gapping that's been taking place in the global supply chain, not just for the green industry, but all of horticulture, all of agriculture, and all non-agriculture. We've learned a lot of lessons, and so our supply chain is much more resilient than what it has been. If you look at inflation, this is the PCE index, the Personal Consumption Expenditures Index, not CPI. I use this, and I typically focus on this because this is what the Fed uses in terms of its 2% target. And when the PCE index is above 2%, the tendency is to raise interest rates to kind of cool things down. Well, you know all the rhetoric that's been going on in the news about Jay Powell and the FOMC, whether or not they're going to raise rates or lower rates. And right now they're in a monetary easing. And so we're lowering interest rates to stimulate the economy, but you don't want to stimulate it too much because you got a weakening labor market and you got the prices that are increasing. So you don't want to go too far too fast. And that's what Jay Powell's been saying, but that doesn't always work politically, does it? So it's a very interesting time period in terms of the interaction between the White House and FMOC. And we'll have a new chair coming in just a couple of months, and so it's going to be an interesting transition as well. So, but we're just now beginning to feel the impacts of tariffs, and now we got some upheaval, and you see this over here, what I said about the Q1 in 2025, and we built all those inventories, and that's what we've been selling from for 6 to 8 months. And so as those inventories are brought down, we're going to see more. We're going to see a greater increase in the inflation rates. Let me go back here. This increase in 2025, see, we're going down in terms of inflation. The tariffs kick into place, and all this gain in both the headline and the core inflation, that's tariffs right there. But you say, well, Charlie, that's not as big as what it was during the pandemic. What are we worried about? Well, we're heading away from 2%. That's what we're worried about. We're back up to 3% in terms of the core. And that's excluding food prices and energy prices. And if you look at the headline, it's the energy prices that are saving the skin right now because we're drill baby drill philosophy. And so that's offsetting the increases that we're still seeing in terms of food prices. So anyway, we're draining down these inventories, and as those inventories are drawing down, now the tariffs are going to start playing more of a role, and we're going to see some increases in inputs. Now, this is the index of prices paid by growers that I calculate every year, twice a year, one time this time of the year, and then right before cultivate, I update this index, and I have an econometric model built for each one of these inputs: containers, propagated materials, etc. And this is my estimate that I've developed from those models. And it's much like the index of prices paid by farmers that USDA calculates, but I use separate inputs than what they do. So it's a little different in that regard. But the way you read this down here at the bottom, this year-over-year increase, you can see that in 2025, the cost of all of our inputs added all together was 1.6% higher than what it was in 24. And then you go back and forth. And the big years where it increased were in 21 and 22. Well, if you add up all these increases, including the estimate that I have for 2025, then you're basically looking at about a 25% increase in terms of input cost. And that means that all those folks out there, as that 25% has been sent on downstream in the supply chain, if everybody's not followed suit with a 25% increase in price, then they've been sharing margin with their customers. So that's why this particular estimate is pretty cool to get as a check for your individual business as to whether or not you're keeping up with inflation with your pricing. Now notice in 2026, because of all the announcements and everything that have been made, my number now is 3.7%. When I was making preliminary estimates at the end of the year, and I was thinking it's going to be 3.1, 3.2%. Now I've got 3.7. And if you stress test this, it could be even more, depending on if an alternative to the emergency tariff that were put in emergency tariffs that were put into place, if the current administration finds a different mechanism to put those back in place, then again, that's the risk and uncertainty that we're looking at. Labor, Labor availability, you can see the JOLTS report, the latest one that just came out. You see the Fed has done its job in terms of killing off jobs. This is job openings, what's slowing things down, cooling inflation, and that's been the effect. And we're starting to see a few more layoffs, although that's nothing to really be concerned about right now. The number of people quitting is kind of moving sideways. The number of hires has been going down a little bit, but still nothing's really, the job market's weakening, but it's weakening at a rate at which it's not untenable right now. We've gone from having 2 jobs for every person looking for a job in the height of the pandemic to less than 1 job. There's 0.8 jobs available for everybody looking for a job right now. So again, that's reflective of the weakening job market. What can we do about it? Well, comprehensive immigration reform is what you do about it. Did I just say those 3 words? It's all math. It's you can blame a lot of things, but it's all math. And so the GDP is also a function of the number of people working. So if you have fewer people working, fewer people willing to leave their house to go to work because of certain situations in Minneapolis and Chicago, et cetera, it creates a lot of uncertainty. And again, I'm not talking partisan politics here. I'm talking about the effects of various policies on the jobs market. As an economist, it's pretty easy that the numbers don't lie. One of the numbers that we see, the employment cost index, that's what it's costing folks to hire people. In agriculture, it'd be synonymous to, say, H-2A rates and so forth. But you can see that the rate at which wages are going up is decreasing. Now, I didn't say wages were decreasing. I said the rate at which those increases is going down, right? So it's still going, the wages are going up, but they're slowing down. Now, let's talk housing. There's a lot of words on here, and I've supplied the PowerPoint, and you're going to be supplied the PowerPoint. So I wanted to put a few extra words on here to explain some of these graphs, so you can go in here and use the PowerPoint. And I don't mind you actually having the PowerPoint file, because even there's what I put on the slide. There's even some notes that are in the slide notes about where I got some of this data. So you could use some of that and track some of this stuff yourself. But this is a projection of the existing home sales and where they're forecast to be in 2026. And over here on the right, you see all these circles right here. These are different real estate forecasts by the most renowned market researchers in real estate, and you can see the range in terms of what they're expecting in 2026. So it's going to be somewhere in this gray band by the year's over, according to these forecasts. And so, depending on who's right, where you're going to see an increase, or it's going to stay the same, or it's going to be decreased. And it's kind of funny. Well, the reason I'm laughing is that, all right, is the market going to go up, or is it going to go down? And so then you say the answer, yes. And that's why I'm laughing, is because, again, you've got a lot of uncertainty here, and that uncertainty comes down to mortgage rates. And I'll get to that here in a second. But that's creating some of the uncertainty in terms of some of these forecasts, because different people are assuming different levels of mortgage rates. Now, housing starts. Remember, you got existing homes. That's not the homes that are being built. Those are the homes that are already built, that are in the pipeline, that are being offered for sale, right? Those are existing home sales. This is housing starts. Same kind of, you got different forecasts here. You got the Erdman housing tracker, that's the most optimistic. And you got the Goldman Sachs, that's the most pessimistic, and predicting the different starts within the industry. But the point is that we've been producing a bunch of houses, but not as many as we need. we have a demand for 1.7 million single family housing units, and we're not producing that many. And so there's a headwind there, both from a supply standpoint and a demand standpoint. If you focus in on single family specifically, still the same kind of range there. And we just don't know where that's going to be. But most of these are forecasting increases in the number of single family housing starts in 2026. That's the good news. Why is that good news? For every single family home that's built, it's got to put flowers, shrubs, and trees around that. And it's either DIY or landscape services. So this is why I'm kind of optimistic about 2026, unless the wheels fall off the cart economically. But you'll see in a minute that's not what I'm thinking. And here's multifamily. I'm not going to spend a lot of time on that, but those landscapers that are might be listening, if you're in the commercial real estate side, you've got an even bigger range in terms of these forecasts, and there's a lot of uncertainty there. But we've been producing a whole heck of a lot of multifamily units since 2022. So again, there's only so many renters that are out there. So that's where you want to see a little bit of drop in demand, and now it's climbing its way back up there. Now, all this being said, all this in terms of a supply standpoint, and again, it's like product that's on the shelf at the retail. You're not going to be able to sell it if it's not available for sale. So this active inventory is it's a foretelling of where we are right now as of the end of the year 2025, and most of the real estate prognosticators are foreseeing an increase in housing inventory. The key is whether or not if they're going to be at a price at which people can afford. And now this is the price forecast. This is not actual prices. All these firms down here at the bottom along the x-axis, these are different companies that have their own forecasters, and that's all they do is forecast home prices and these other forecasts I've just shown you in terms of supply. And you can see that the forecast range quite a bit from home prices staying the same to going up 4.5% or being down by 1%. Now that's not a big range. Let me take a quick sip of water. Oh man, that's good stuff. Okay, so I promise you it's water. Home price forecast there, it's mixed, but I mean it's not a great big range, but there is a range there. If you look at where home prices went up from 2024 to 25, right? I want to point that out. We're not talking about 26 yet. The Sun Belt area, that's where housing prices declined the most. You see the Midwest and Northeast, you got some pockets where the prices had decreased, but for the most part, prices were still increasing in that neck of the woods. So again, kind of a headwind in terms of buying and selling homes in those areas. So what's the kicker? What's the main headwind is mortgage rates. And you can see the mortgage rate forecast. It's the same thing. There's some people forecasting for interest rates to move sideways. Some of it, the interest rates go up, mortgage rates, I mean, and then some are calling for mortgage rates to go down. The average here is 6.2%. And that's roughly where we are now. So that would mean that mortgage rates stay the same. Aha. Glad you noticed that, young grasshopper. But here's the kicker. If you on this chart on the left-hand side, if you look at the average range in the 30-year mortgage rates since 1972, that range in a year is 1.4 percentage points. So that means that mortgage rates during the year will be either 70 basis points down or 70 basis points up from whatever that forecast is going to be. So if we take the average of all these forecasts, then it's going to be 6.2% by the end of December 2026. sometime during the year, usually right before school starts and so forth, you'll see some movement in mortgage rates. And if it comes down 70 basis points, that's going to be in the 5.5% range. Okay, why is that important, Charlie? It's because most market research, when they're asking these people that are on the sidelines that are wanting to buy a house, but they're waiting, 5.5% is the tipping point. The most people are saying when it gets below 5.5%, they'll pull the trigger on buying a house. So that's why I'm kind of optimistic here. If you look at historic trends and the average of the forecast, and the historic trend says that that range could fall in that 5.5% range. When that happens, man, we're going to pull the trigger on some buying and selling of houses and building of houses, and folks are going to put flower shrubs or trees and then buy landscape services. So that's why I'm pretty optimistic. And if you look at the mortgages that are out there right now, the light blue is the lowest interest rate, and the red is the highest interest rate. And you can see back in the post Great Recession days, you had more people that were above 6%, and we're not back to those days. Boy, I'm sorry about that cough, folks. It's just a little tickle there. All right, so let's look. We got all these interest rates here, and we got a bunch of people that are going to be refinancing whenever things get better from a mortgage rate standpoint. Now, even with that, even with all that, here's some roughly good news. If you look at delinquency rates of mortgages and home and equity lines of credit, they're way down here in terms of delinquency rates. They're nowhere near what they were back in the Great Recession. So again, the housing market is on much better footing than what it was. And again, here's the latent demand for the 1.7 million housing units comes from right there. Millennials and Gen Z, and then Gen A. After that, that's we're telling off in terms of the number of people in the younger age bracket. So don't talk to me about 20 years from now. It's not as optimistic as what I'm going to sound right now. But the millennials are 38% of home buying, and there's a bunch of them. There's a bunch more millennials than there were boomers. And of course, boomers over here on the right are in the downsizing years and the tail end. I'm in this bar right here, right? I'm 63 years of age, and I'm right in there. And so I'm still a major part of the lawn and garden market right now. But the millennials are going to be in numbers, they're going to be outweighing what boomers did. And boomers built this business. And here's the thing that's pretty cool is that you look at the market research on how millennials spend their money, they spend it pretty much the same as when boomers were those ages. They really resemble boomers quite a bit. So I'm pretty optimistic. Now, you got consumers. I want to talk about consumers for a second. Incomes have been rising. And, C. Northcote Parkinson, his law number 2 was expenditures rise to meet income. Incomes have been going up. We got the COVID checks and so forth, and that both from a nominal standpoint on the light aqua colored line, and then the dark purple line there is the real, means adjusted for inflation. So wages are still increasing. So we're going to be spending money, and there you see it. There's the personal consumption expenditures. Once we got through the pandemic, then we've been buying stuff still, and so we've been doing our part as consumers. We're buying stuff, and we've been buying services here lately more so than goods. The red line is services, and before the pandemic, we were a service-based economy. Then we turned to a goods-based when we were sheltering in place and staying at home and buying everything from Amazon we could. And so we switched. And in 2023, we switched back to being a services economy, and we're pretty much where we would be normally. Is we've come back full circle. Now, flowers, seeds, and potted plants. This is the floriculture side of the industry. I'll show you the shrubs and trees in just a second. But the flower shrubs, and flower seeds and potted plants, you see that before the pandemic, the pandemic started the red arrow, and then we had an increase, and then we had a plateau. Then we had another little increase, another plateau, and then another smaller increase, and now we're at another plateau. The thing that hasn't happened is we've not gone back to 2019 levels of consumption. That's a good thing. Now, when these dips start happening, that's when I start holding my breath, because because in every other time since 1948 that we stayed at home, we got a bump in the arm in terms of the lawn and garden activity, and then things went back to where they were. Well, so far we haven't gone back to where they were. If you look at the real private residential fixed investment numbers, that's what we spend on basically our houses. And our landscapes are built into this. They're baked into this, and I can't separate it out because the guys won't do that for me. The holders of the data. So the best thing I got is my remodeling activity, which does include flower, shrubs, and trees, and so that's projected to be roughly where it was in 2020, the 25, and then heading back down to this 2%. In terms of remodeling activity. All right, so let's go full circle. We got we're going to have some time for questions here in just a second, but let me talk about a recession. Is it imminent? No, it's only about a 25 to 40% likelihood. Not really any higher than what it was last year at this time, in spite of all the stuff that's been going on. So the National Bureau of Economic Research, that's what NBER stands for. They're the ones that basically say that we're in recession or not, and they typically look at all these different indicators down at the bottom here as what they're foretelling of whether a recession's coming. They're looking at those things, and this chart right here is showing you the numbers that are down of all these metrics. The ones that are down, that would basically be a red flag. Anything's below the line here would be a red flag. Well, there's not. There's only 3 of the 6 that are negative, and they're only slightly negative. So it's nowhere near what it was over here during the pandemic. So, all right, there's not much of a chance right now. Ceteris paribus, holding all of the things constant. What tweets are coming down the pike? Well, what fiscal policy measures are going to be put in place? I can tell you a little more detail if you tell me that. But that's at least right now, we're not seeing a bunch of these indicators that I'm flipping through. This is my dashboard, and I'm not going to read all these. I've shown you these charts before, but all of these indicators, and you'll see it in the slides when you get them, they're not showing the recession. The only one that's really showing recession is the Conference Board Leading Economic Index. And that's the one that's showing the economy 11, 12 months down the road. That's why they call it the Leading Economic Index. It's showing, but it's only it's not a strong signal right now. It's a weak signal. So that's the only one. So again, not really a lot of concern there, but there's some commonalities. Is the growth is going to be well below the 2.5% and 3% trend historically. So we're going to still be growing, but it's not going to be. We're going to see offsets to the growth that we saw during the Bipartisan Infrastructure Act and the CHIPS Act and all those investments that we made into the economy and the stimulus that was causing. We're riding out that, and when you put in one big beautiful budget act, it's going to have substantial tax savings for everybody that's listening to my voice right now. You ought to know what is in the one big beautiful budget act from a tax standpoint, because there are some tax advantages for you in there. It's just going to cost the country about $3.8 trillion. It's going to add $3.8 trillion to our national debt, which is already too high, and we got to correct that at some point. So, but that's a topic for a different conversation altogether. Tariffs are going to continue pressuring inflation, business investment. That's a given. All right. Because even SCOTUS coming in and saying, nope, and slapping the administration's hands, saying, nope, can't do that. They're finding a different way, or trying to at this point, to keep those in place. Labor and housing is still going to be weak, and that weakness is going to persist. But remember the mortgage rate discussion. There is some hope there that that tipping point will occur and people will start flipping the switch and we'll sell more flower shrubs and trees to go around those houses that are bought and sold. The Fed is likely to continue some rate cuts, particularly with the different philosophy coming in to lead the FMOC, and there'll be some more monetary easing. So that'll be the stimulus. We just have to keep an eye on inflation big time. AI investment remains a bright spot, but I will tell you right now, it's an overvalued asset, and there's going to be a market correction in terms of the overvalued AI stocks. There will be a market correction, period. I know it's coming. Can I tell you when? No, but it's coming, right? So make adjustments accordingly. Consumer spending will weaken as real wage growth stagnates, right? As that wage rate, employment cost index discussion, as the rate at which those wages increases, that slows down, then people's disposable income is going to increase, but at a slower rate, and that consumer spending will weaken a little bit. But right now we've been very resilient. So when you consider all this, and let me stop sharing my screen here for a second, go back here. All right, now you should just see me right here instead of the PowerPoint. But we've got a few minutes here, eight minutes or so, Chris. Did any questions come in while I was doing all this pontificating?
Yeah, we got a couple, Charlie, that came in. One is a really good one, actually. There's been a lot of investment by private equity into the landscape contracting business. What are your thoughts on that? We've seen a lot of, I know particularly in like the Boston, Massachusetts area, private equity buying some of the larger landscape contractors and kind of a roll-up of many contractors. And do you have any advice for how that might change things for growers that supply them?
Yeah, that same thing is happening on the grower side, just not just not at the same rate. You know, the business and acquisition, or the merger and acquisition activity in terms of landscapers has been not at an all-time high, but it's been busy. And same way with hardware and building supply. The acquisition activity there is phenomenal right now, all across the country, not just the Northeast. We have learned some lessons in from the acquisitions of the past. And so I think a lot of those deals are structured a lot differently than they were 20 years ago, and that there's the possibility of a win-win without all that black powder coming into the industry. There's not just an expectation, thou shalt pay me 35% margin or I'm leaving, but there's a little more caution that's being exercised in how those play out. And for the most part, many of the existing management teams are left in place to run those businesses instead of doing a wholesale swap. So, Chris, I don't see a lot of the red flags that I used to see in a lot of that acquisition activity. But you got to remember, in the good economic conditions, a landscaper, a landscape service firm will bring the margins that's required for that black powder to come in the first place. But when soon as economic contraction starts, it's the landscape sector that feels it first. So that's the sector that's most sensitive to any type of contraction within the housing sector, and so I on the one hand would say, okay, that's greater risk. But here's the flip side, Chris. I just showed you a latent demand for 1.7 million housing units from a population and demographic standpoint. And we're not producing 1.7 million units. So there's a latent demand there. We need more houses being bought and sold and started. And all those houses need landscape services. So I'm on the whole, I'm still very bullish on the landscape sector, regardless of how the ownership structures changes. So
Okay.
it doesn't worry me so much. And on the grower side, you've seen a little bit of that black powder come in the last couple of years as well, and some pretty notable deals have been made. And again, most of the red flags that I would have looked at in the back in the 80s when I was doing this, and the 90s, man, I just don't see those same kind of arrangements. They're making provisions on making sure that's a win-win, at least at realistic expectations in terms of margins, and making sure that the the value proposition that's brought to the table is the same. And so anyway, I'm not as pessimistic in some of those cases as I have been in the past.
Okay. Good answer. That's very good information. Another question came in. What do you think about independent garden centers and their performance going forward? I know there's a huge range of results that independent garden centers see, with some, knocking it out of the park and others really struggling. But any thoughts for that part of the green industry overall?
Yeah, and I do a little bit of data sharing with Danny Summers of the Garden Center Group, and then there's Ian Baldwin is capturing some of the retail numbers within the retail side of Your Market Metrics. So you're exactly right in saying the performance has been mixed and all across the board, but there's some commonalities of both growers and the retailers that have been doing well, and it's been those retailers that basically are marketers of experiences that have done better. It's not that the product is almost not, it's not secondary, but they create the experience in addition to just selling the flowers, shrubs, and trees, right? There's the whole package, and it's some one-stop shopping, but it's a strong merchandising slant. It's an understanding of what the consumer's looking for. It's retailers who are, investing in making it easier for consumers to buy, whether through technology or what have you. And those are the ones that are being most successful, and the ones that are making money even in rainy conditions. But
Okay.
I guess one thing, Chris, that I would not, there's no way I can overestimate the value of being in a peer group like that and sharing of information. And it truly is that those that are in at the grower level, I see it, that those that have been part of a peer group like Eagle outperform those that have not been part of a peer group. So that, to me, that's very important advice for all sectors. And you got on the landscape side, you got Marty Grunder, you got Jeffrey Scott, and they all have different peer groups. And landscapers who are in those peer groups tend to outperform others. And then same way as retail. So I think just the sharing of best practices is an important aspect of being in those peer groups.
Great. Well, we approached the top of the hour, so I'm going to end it there. A couple of final notes before we close out. All of Farm Credit East webinars, past, present, and future, reside at farmcrediteast.com/webinars. So this webinar and the presentation materials will be archived on that web page. Give us 24 hours, but we generally have it up by the next day. We have a number of other webinars coming up, which you can see on that page, any upcoming events. Thank you to the Horizon Farm Credit attendees that we have from Pennsylvania and Mid-Atlantic. With that, I'll thank Charlie for your time and your expertise and information. This was really informative. Thank you very much.
You're welcome, Chris. Thanks for the invite.